The silver market just did something it almost never does in public. It stopped acting like a sleepy commodity, and it started acting like a strategic weapon. In the last few sessions, silver ripped higher, premiums tightened, dealers changed the rules, and government language quietly shifted toward critical minerals and national security. That combination is not normal. That combination is the smoke before the fire. Welcome back. This is John A.G. from the Currency Academy, and today I'm going to show you why this silver surge is not just a trade, it's a warning flare. Because the real story isn't the green candle on your screen. The real story is what happens when the world needs physical metal, right now, at the exact moment the system is built on paper promises. Before we go deeper, quick mission check. If you value original work and you're tired of recycled copycat content, subscribe right now. And if you're part of the movement against copycats, comment John A.G. Best so I can see you. That one comment tells me you're here for real analysis, not recycled noise. Now let's get surgical. Most people think silver moves for one reason. The dollar went down, rates went up, risk on, risk off. That's surface level thinking. Silver doesn't explode like this because of one headline. Silver explodes when multiple pipes clog at the same time. And right now, the pipes are clogging. You've got a market that's been running structural deficits for years. You've got industrial demand that doesn't care about your feelings. You've got investors waking up because inflation is still eating their purchasing power. And now, this is the key, policymakers are starting to talk like supply chains are a battlefield. That's the shift. When governments start using national security language, they aren't making conversation. They're preparing options. And options in government usually mean intervention. So let's start with the easiest signal to read. The difference between spot price and real-world price. Spot is a number, it's a reference, it's a headline. But the price you pay for physical is the truth. And the truth is written in premiums, delivery times, and dealer behavior. Because when a market is calm, dealers compete for your business. They run specials. They offer small orders. They buy back whatever you bring in. Everything feels frictionless. But when the market tightens, the rules change, quietly, without apology. Minimum order thresholds go up. Free shipping disappears. Buybacks get restricted. Certain products go temporarily unavailable. And then, suddenly, it's not about price anymore. It's about access. And access is the first stage of scarcity. Here's what you need to understand about silver that almost nobody explains in plain English. There are billions of humans on Earth, but only a limited amount of silver that is actually available to be bought, shipped, and delivered. A lot of silver exists on spreadsheets, but not inside a vault that's willing to part with it. So when demand surges, the public doesn't feel it through a shortage sign at first. The public feels it through rules. Rules are the early warning system. If you've been watching closely, you've seen the market doing that thing it always does, right before a real squeeze. It tries to distract you with price volatility. Big up day, big down day. People panic, people chase, people sell, people get shaken out. And while retail is emotionally spinning, the industrial buyers keep doing what they do best, quietly securing supply. This is the part most investors miss because it isn't cinematic. It doesn't trend on social media, but it's the part that changes everything. Industrial demand isn't like retail demand. Retail can pause. Retail can wait. Retail can change its mind because a chart looks scary. Industry can't. If a manufacturer needs silver for electronics, medical devices, grid components, or defense systems, they don't get to say, let's skip this quarter. They need the metal. Silver demand in the real economy is not optional, it's structural. And when demand is structural and supply is tight, the market doesn't adjust politely, it snaps. Now zoom out with me, because silver isn't isolated. Silver is sitting inside a much larger problem that the world refuses to solve. Debt. We are in the era of permanent deficits, and people love to argue about timelines, but the timeline doesn't change the destination. If the system requires constant borrowing just to stay upright, the system is fragile. And fragile systems have one favorite trick. They dilute the currency instead of admitting failure. That's why, even in years when inflation cools on paper, people still feel poorer. Because the real cost of living isn't a chart. It's your grocery receipt, it's rent, it's fuel, it's everything that keeps your life running. So when citizens realize their savings account is a slow-motion leak, they start reaching for something the government can't print. And silver lives right in that lane. But this time, silver isn't only a monetary escape valve. This time, silver is also a strategic material. And that's where the story becomes dangerous, because the moment silver is treated as strategic, the rules of the market change. Let me explain the difference in one sentence. A normal commodity rises because demand increases. A strategic commodity rises because demand increases, and then governments show up. That's when it stops being a price story and becomes an allocation story. Who gets the metal first? The investor who wants protection, or the supply chain that keeps a military system running? I want you to hold that question in your mind because it's going to come back later like a boomerang. Now, the mainstream crowd wants you focused on the chart. They want you obsessed with technical levels. They want you arguing about resistance, support, RSI, and moving averages. And listen, those tools matter. They're useful. But they're not the core of this story. The core of this story is physical availability. The core of this story is the paper to metal gap, because paper silver can be created with a keystroke. It's a contract. It's a claim. It's leverage. Physical silver cannot be created with a keystroke. It has to be mined, refined, shipped, and held. And that pipeline is not expanding at the speed demand is rising. So when the market surges and you think, I'll just buy later, you're not only betting on price, you're betting on inventory. And inventory is the one thing that disappears first. Now let's talk about the national security angle more directly, because people hear those words and they assume it's just political theater. It's not. When the government frames processed critical minerals and derivative products as a national security issue, they are laying the groundwork for action. That action can take different forms. It can be stockpiling, it can be incentives for domestic production, it can be tariffs, it can be restrictions, it can be priority allocation, it can be emergency powers. And here's the part that should make your stomach tighten. You don't need a full-blown emergency decree for the market to react. All you need is the credible possibility of intervention. Because the moment big buyers believe policy might restrict access later, they rush to secure supply now. That's the self-fulfilling squeeze. And that's why silver can go from quiet metal to panic bid faster than people can emotionally process. Now I want to address something that confuses almost everyone in their first year of stacking or trading. They see silver surge, and they assume it must continue straight up forever. That's not how this works. Silver moves in waves, it sprints, it pauses, it snaps back, it fakes you out. And the purpose of those snapbacks is psychological warfare. Silver is not just a commodity, it's a battlefield of emotion. If you've ever watched silver rip higher and then slam down in the same week, you've felt it. That whiplash isn't random, it's a feature. Volatility is how leverage gets washed out. Volatility is how weak hands get shaken. Volatility is how the market transfers metal from panicked people to prepared people. So if you're watching this and you're new, here's your first survival rule. Do not let speed force you into stupidity. You don't need to win it all this week. You need to survive long enough to benefit from the structural forces that are building. And those forces are real. Now, let's cut through another illusion. People say silver can't go much higher because there's plenty of supply. They say it because they've never studied how silver is actually consumed. Silver is not like gold. Gold is hoarded, gold is stored. Gold is recycled at extremely high rates because it's concentrated and valuable enough to recover. Silver is different. Silver is used up. Silver is dispersed across billions of products in tiny amounts. Electronics, medical components, solar applications, industrial contacts, high-performance systems. And when silver is dispersed like dust, it becomes uneconomical to recover at scale. So the world is quietly burning silver. Not metaphorically, literally. And that means supply is tighter than it looks, because above-ground silver doesn't automatically mean available silver. And this availability depends on willingness to sell. And in a world of debt expansion and policy risk, willingness to sell collapses. This is how shortages form. Not in one day, but structurally, then suddenly. Now let's talk about the most misunderstood part of this entire market: paper delivery. A lot of people watch exchange reports, and they assume the system is backed 1.1 by physical inventory. It's not designed that way. It's designed for liquidity. Most participants don't want delivery, so the machine runs smoothly. Contracts roll. Positions settle. Everything looks fine. But the moment you get a wave of participants who want the metal, the system becomes a stress test. And in stress tests, confidence matters more than numbers. Because if the market believes delivery is easy, the paper system can keep spinning. But if the market believes delivery is difficult, the paper system becomes a countdown. And when that belief spreads, you see a few things happen fast. Premiums rise even when spot pauses. Dealer restrictions tighten. Delivery times stretch. And the narrative shifts from price action to availability. That narrative shift is the spark that ignites a true run. So here's your first engagement question, and I want you to answer honestly. If the market forced you to choose between paper profits and physical control, which one would you choose, and why? Because your answer tells me whether you're here to trade a move or protect your future. Now I want to connect silver to something most people refuse to connect it to: the grid. Modern life is electricity. Transportation is moving toward electricity. Data is electricity. Defense is electricity. Communications are electricity. And silver is embedded in the hardware that makes electricity work efficiently. That's why the national security framing is not a conspiracy. It's a logic chain. If you weaken the supply chain for the materials that power critical infrastructure, you weaken the infrastructure. And in a world where supply chains are already fragile, the incentive to secure strategic inputs becomes overwhelming. Now here's the cliffhanger that should keep you watching. What happens when a government decides silver is too important to leave to the free market? I'm not saying that happens tomorrow. I'm saying the pathway exists. And the moment that pathway becomes credible, the demand curve changes, because then you're not competing with other investors. You're competing with mandates. And mandates don't care about spot price. Mandates care about supply. Now, let me bring it back to the real world again, because you can feel the difference between a normal rally and a panic rally in one simple place: behavior. Normal rally behavior looks like this. People debate, people wait, people watch, people plan. Panic rally behavior looks like this. People buy whatever is left. They stop asking about premiums. They stop asking about perfection. They just want exposure before the door closes. And I'm already seeing early signals of that shift. Not in the comments, not on social media, in the rules, in the restrictions, in the sudden feeling that the market is tightening its grip. Now, this is where I'm going to be very direct with you. There are two ways to lose in silver. One, you panic at the bottom and sell because you can't handle volatility. Two, you wait too long because you think you'll have unlimited time and unlimited supply. Both mistakes come from the same place, underestimating how fast sentiment can flip when scarcity becomes visible. Because scarcity doesn't ask permission. It doesn't schedule itself politely. It hits, then the crowd reacts, then the window closes. And that's why your strategy matters more than your prediction. So let's talk strategy in a clean, simple way. Physical is not about getting rich next week. Physical is about stepping out of counterparty risk. Physical is about holding a tangible asset that doesn't depend on a bank staying solvent, a broker staying honest, or a policy staying friendly. Paper is different. Paper is a tool. Paper can make money up or down. But paper requires discipline, risk controls, position sizing, and emotional maturity. Without that, paper turns into a blender. And the market loves feeding on the undisciplined. So if you're doing both, treat them like two separate worlds. Do not mix physical emotions with paper decisions. Do not sell your insurance because you got spooked by a chart. And do not gamble with paper because you want fast money. Now here's the second engagement question. And this one matters because it tells me what you're really watching. What do you track more? The spot price or physical premiums and inventory? Answer that because it reveals whether you're watching the scoreboard or the battlefield. Now let me give you the final piece of this puzzle: timing. People ask, is this a 1-month story or a 10-year story? And that question sounds smart, but it can become a trap because the system can grind for years and still break in a week. That's how leverage works. That's how confidence works. That's how scarcity works. You don't get slow motion headlines when a critical threshold is crossed. You get a gap. You get a surge. You get a scramble. And suddenly the conversation is no longer, should I buy? It becomes, can I still buy? That's why I'm telling you to focus on signals, not noise. Watch premiums. Watch delivery times. Watch dealer rules. Watch policy language. Watch how fast narratives shift from investment to security. Because when the narrative becomes security, the market gets violent. And this silver surge has the fingerprints of that shift. One more layer, and this is where it gets uncomfortable. When a dealer raises minimums on buybacks, it's not just customer service, it's risk management. It means they do not want to be the sponge that absorbs panic selling in tiny lots, while their wholesale supply is uncertain. If their pipeline is tight, they can't promise instant liquidity to everyone, because they don't know what replacement inventory will cost tomorrow morning. That is a stressed market. And then there's the timeline pressure. Government language often includes windows, review periods, implementation clocks, deadlines that sound boring until you realize what they do. A 180-day review isn't a calendar note. It's a countdown that tells big buyers, make your move before the rules harden. That's how you get front running. Not retail front running, industrial and institutional front running. Now imagine the next domino: a stockpile announcement, a procurement memo, a defense contractor quietly locking supply, a major manufacturer hedging forward because they can't risk being short metal. None of that needs to be public to move the market. It only needs to be real. And if you think that can't happen, look at history. Strategic reserves have existed for decades. Export controls exist. Priority allocation exists. The playbook is already written. The only question is when the pressure becomes high enough that leaders justify using it. The headline is the moment the market realizes paper convenience has limits. Because when enough people demand physical at the same time, the system doesn't negotiate. It reprices. And the first people who notice won't be Twitter traders. It will be the refiners, the mints, the logistics teams, the wholesalers, the people who touch metal, not screenshots. So if you're waiting for a perfect signal, be careful. The perfect signal often arrives after the opportunity is gone. Now, let's wrap this into something actionable. If you got value out of this breakdown, subscribe right now. And don't forget, if you're part of the movement against copycats, comment John A.G. Best so I can see you. And I want you to do one more thing. Look at your plan, not your hope, your plan. If silver pulls back tomorrow, do you panic or do you stay calm? If silver rips higher tomorrow, do you chase or do you stay disciplined? Because the market doesn't reward excitement, it rewards preparation. The price on the screen is loud. The truth in the physical market is quiet. But quiet truth is what changes lives. And the next phase of the silver story won't be decided by a chart pattern. It will be decided by availability. Take care of yourselves, take care of each other, and I will see you in the next video soon.